Welcome to Market Brief, After Hours. It has been an absolutely wild week on Wall Street and across global exchanges. We've seen massive swings, tech-driven rallies, geopolitical tension in the Middle East, and major central bank interventions. To help us make sense of this roller coaster, let's dive straight into the key takeaways from today's action. It feels like investors are constantly balancing incredible corporate earnings against some pretty heavy macroeconomic headwinds. How would you summarize the mood out there?
Roller coaster is the perfect term for it. We are seeing a market filled with both deep anxiety and incredible opportunity. On one hand, you have robust corporate earnings, especially in the tech and artificial intelligence sectors, which are keeping investors excited. On the other hand, surging bond yields, stubborn inflation fears, and escalating geopolitical conflicts in the Middle East are keeping everyone on edge. It's a classic tug-of-war between micro-strength and macro-stress.
That tug-of-war was on full display in the U.S. markets on Friday. The major averages managed to close significantly higher, capping off a very dramatic week. Let's look at the final numbers. The Dow Jones Industrial Average gained about 277 points, or 0.53%, to close at 52,485. The S&P 500 added 0.7%, ending the day at 7,490. And the tech-heavy Nasdaq Composite led the charge, rising 1% to close at 25,374. Now, despite the sharp swings we saw all week, including a brutal Wednesday where the Dow plunged over 1,100 points, the weekly and monthly pictures still look remarkably resilient, don't they?
They really do. Despite that Wednesday pullback, which was the Dow's worst single-day decline since April 2025, the major averages managed to post gains for the week. The Dow and the S&P 500 both climbed about 1% over the 5 days, while the Nasdaq rose around 1.6%. More importantly, for the broader trend, the Dow notched its fourth consecutive positive month in July, up 0.3%. However, it wasn't a clean sweep across the board for the month. The S&P 500 dipped 0.1% in July, and the Nasdaq fell 3.2%, reflecting some sector rotation and profit-taking in big tech.
Let's talk about what drove Friday's optimism. Amazon was a massive catalyst, surging 15% after reporting better-than-expected second-quarter revenue. That strength was largely driven by its cloud computing business, AWS, which really reinforced investor confidence in AI spending. This came right after Microsoft jumped 16% on Thursday due to strong Azure cloud growth. But it wasn't all good news in big tech, was it?
No, it wasn't. Apple actually went the other way, closing more than 7% lower. Even though their fiscal third-quarter revenue beat expectations, helped by a massive 22% jump in iPhone sales, a shortfall in their service revenue disappointed investors. It shows you how high the bar is right now. If a company doesn't hit every single metric, the market is quick to punish the stock.
While tech earnings were boosting sentiment, the bond market was telling a much more cautionary tale. Treasury yields surged on Friday. The 30-year Treasury bond yield spiked to its highest level since 2007, ending up at 5.25%. Meanwhile, the benchmark 10-year Treasury note yield topped 4.71%, its highest level since January 2025, and the 2-year note rose to 4.273%. What is driving this sudden surge in yields?
It comes down to inflation fears and a shifting outlook on monetary policy. Investors are losing faith in Federal Reserve Chairman Kevin Warsh's ability or commitment to aggressively curb inflation. Even though he stated he is committed to the fight, his comment this week that we've got no magic wand didn't exactly soothe the markets. On top of that, we had some Fed officials openly stating on Friday that they favor raising rates in the autumn to put the brakes on inflation. Remember, the central bank held rates in a range of 3.5% to 3.75% on Wednesday in a 9-3 vote. But those 3 dissenting votes show there is growing appetite for more hikes. When you couple that with U.S. employment compensation costs rising 0.9% in the second quarter, which was slightly above forecasts, it's clear that wage pressures are still very real.
And of course, there is the energy component. Higher oil prices are incredibly inflationary, and we saw West Texas Intermediate crude futures rise over 1% to settle at $84.67 a barrel, while Brent crude advanced to $90.12 a barrel. This spike was directly tied to some alarming geopolitical news out of the Middle East, wasn't it?
Absolutely. Iran claimed it attacked two commercial tankers transiting the crucial Strait of Hormuz under U.S. military escort, and state media reported that 4 other tankers turned back. While U.S. and British maritime security organizations haven't officially confirmed the attacks, the threat alone was enough to send energy markets higher. We also saw a drone attack damage 2 liquefied natural gas ships at Egypt's port of Damietta earlier in the week. Any disruption to these key global shipping lanes immediately feeds back into inflation expectations, which in turn pushes Treasury yields higher.
It is a complex web of interconnected factors for sure. We are going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Let's shift our gaze across the oceans and look at how international markets fared on Friday. European markets started strong, but seemed to lose steam as the day went on. The Pan-European Stoxx 600 index was up as much as 1% early in the session, but ended up closing down 0.1%. What was behind that late-day fade?
It was a mix of local economic data and those rising global yields we just discussed. In Germany, the DAX managed a tiny gain of 0.1%, even though their seasonally adjusted unemployment rate rose to 6.4% in July 2026, which was worse than expected. In France, the CAC 40 rose 0.3%, but they are facing mounting inflation pressures. French annual inflation accelerated to 2.1% in July, driven by rising service and energy prices. Over in Italy, the FTSE MIB gained 0.13% as their inflation actually eased to 2.8%, thanks to some temporary relief in wholesale energy prices. So it's a very mixed economic picture across the Eurozone right now.
Now, if Europe was quiet, Asia was the complete opposite. We saw some absolutely staggering moves, particularly in South Korea and Japan, as investors rushed back into AI and semiconductor stocks. Tell us about the KOSPI index in Seoul. Those numbers look almost unbelievable.
They are historic. The South Korean KOSPI skyrocketed by an astonishing 17.91%, gaining over 1,001 points to close at 6,595. This was fueled by a massive rally in chipmakers after SK Group chairman Chae Tae-won disclosed he bought 3,620 SK Hynix shares on the open market, worth about 4.9 billion won. That show of confidence sent SK Hynix shares soaring nearly 30%, while Samsung Electronics jumped over 26%.
That is a breathtaking move for a major index, and Japan's Nikkei wasn't far behind, climbing over 4% on Friday.
Yes, the Nikkei jumped 4.03%, and the broader topics rose 1.29%. This came as the Bank of Japan decided to keep its policy rate unchanged at 1.00%. Tech stocks there also had a massive day, with flash memory maker Kioxia Holdings surging almost 18% after stellar quarterly earnings, and SoftBank Group jumping nearly 14%. But the big story in Japan is also in the currency markets. Central bank data suggests the Bank of Japan may have conducted a massive yen buying intervention, potentially selling up to $58.97 billion to support their currency.
That is a massive intervention. And that brings us perfectly to the Forex market, where we saw some dramatic shifts in currency pairs. Let's start with USD-JPY, which experienced an absolute capitulation.
This was a massive bearish move. USD-JPY plunged 1.27% to close at 157.46. The daily candle completely engulfed several days of prior price action. From a technical standpoint, the pair aggressively broke below its 50-day simple moving average at 161.31, its 100-day average at 160.03, and ultimately closed below its 200-day average of 157.90. This signifies a dramatic shift. If it stays below that 200-day average, we could see further downside discovery.
What about the euro and the pound against the US dollar?
Euro-USD had a quiet consolidation session, closing down slightly at 1.1525. It's currently sitting above its 50-day moving average of 1.1482, but remains capped by its 100-day average at 1.1568 and 200-day average at 1.1629. GBP-USD, on the other hand, extended its advance, closing up 0.14% at 1.3483. It is trading comfortably above its 50-day SMA of 1.3364, its 100-day SMA of 1.3400, and its 200-day SMA of 1.3398. The bulls are firmly in control of the pound right now. Meanwhile, Euro GBP resumed its broader downtrend, closing down 0.15% at 0.8547, well below its key moving averages.
Turning to commodities, both gold and silver had a tough day on Friday as sellers reasserted control. Gold fell 1.49% to close at $4,041, while silver dropped 2.43% to close at $57.56. Both metals remain well below their major moving averages, highlighting a very bearish medium-term outlook. And we saw a similar risk-off sentiment in the cryptocurrency space, with Bitcoin sliding below a key psychological level.
Yes, Bitcoin sank below $63,000, falling over 2% to a 2.5-week low. This was driven by fading momentum for U.S. crypto legislation and disappointing earnings from major players. Coinbase Global, for example, plunged over 10% after reporting second-quarter revenue of $1.22 billion, missing the $1.29 billion consensus. Riot platforms also fell over 8%. To make matters worse, there were security concerns. Reports emerged that nearly 1,200 addresses were drained of over 1,000 Bitcoin, worth about $70 million, due to a security vulnerability affecting certain cold card hardware wallets.
That is a tough blow for crypto sentiment. To wrap things up today, let's look at some individual stock market movers that caught everyone's attention. On the positive side, Dexcom and Monolithic Power Systems had fantastic sessions.
They certainly did. Dexcom closed up over 10% after reporting second-quarter revenue of $1.31 billion, beating expectations and raising its full-year revenue outlook. Monolithic Power Systems also surged over 8% after posting Q2 revenue of $980.6 million, which was well ahead of the consensus, and giving a very strong sales forecast for the third quarter.
But on the flip side, we saw some massive double-digit plunges on Friday, particularly in the social media and gaming spaces.
Yes, Roblox was the biggest loser, plummeting over 26% after reporting 123 million daily active users, which fell well short of the 128.71 million analysts were expecting. Reddit also took a major hit, dropping more than 20% after its U.S. daily active users came in at 53.2 million, missing the 54 million consensus. And finally, GoDaddy led the losers in the S&P 500, falling over 16% after its total bookings of $1.42 billion missed Wall Street estimates.
That brings us to the end of today's episode. If you find this useful, please follow Market Brief After Hours. We will see you next week.